Imagine what would happen to your money if it grew 3 times faster. Instead of retiring in 40 years, it could only be 10. Up until very recently, some of the very best ways that we could grow our wealth have always been gate-kept. We weren't allowed in. We didn't have access to even have that as an option to grow our money. And one of those areas has been venture capital. If you're not familiar, venture capital is basically where a company comes in and they inject money into a new business. And in return, they often take a share of the ownership of that business. So they'll say, look, we really believe in you. We think that your Axe company is going to just exponentially grow over the next few years. So we're going to give you $1 million to grow that business. Then the venture capital company can also advise the business and say, hey, look, if you made nicer handles, maybe you make this steel a little bit cheaper, maybe you don't paint as much of this red, then you'll have higher profits, then you'll have higher margins, then we'll all make more money. Then oftentimes a few years later, the venture capital company will sell their stake in the company, or maybe the company goes public and so they get a big payday. And so to go through that whole process, you've had to have a ton of money and a ton of expertise and a ton of access to be able to get into that world of venture capital. If we've got $5,000 sitting in a drawer at home, we're not going to be investing in businesses. We're not going to even have time to vet the businesses and think about doing that. So despite the potential to earn tons and tons of money doing venture capital, it wasn't even really an option for anybody. You can see in this chart that the potential gains have been really huge, way more even than standard stock market investments, and of course, way more than something like treasury bills or bonds or something else like that. And it's also much, much riskier. Whenever you're picking a company to invest in, typically they're sink or swim. If the company goes under, you've basically lost your investment. Sucks to suck. If the company does really well, you probably get a massive payday. And what I've read about venture capital is oftentimes you get 1 or 2 or 3 massive winners that account for the vast majority of your gains. Everybody else is either just okay or they failed. And so it's those chances that you take to potentially be a part of those big winners, the next Facebook, the next Twitter, the next Google, whatever it is, that makes venture capital worthwhile. So if you could somehow, in theory, invest in venture capital and actually get returns like a successful VC firm does, I'm just going to call venture capital VC from here on out because it sounds better and it's easier to say. If we get returns like a VC firm, it could literally be life-changing. But I don't have the credentials to vet companies, and I don't have billions of dollars to start a VC firm. So as of today, we either don't do VC at all, or we potentially jump into something like this Fundrise Innovation Fund. This video isn't sponsored at all. I have no financial affiliation whatsoever with Fundrise. I just got this little postcard in the mail yesterday, and my interest was piqued. And so I dove into this. I did a bunch of research on it, and I thought, why should I do the research and not share it with you? So let's talk about this fund. Let's talk about exactly what the details are of it. What are we investing in? Do we already have companies picked out? Is it just hope for the future that some guy somewhere is going to pick out companies for us? How much money do you need to be able to start investing in this? Is your money locked away for years and years and years as that company's growing? Or can you get your money in and out like a normal person would need to do with our investments? And of course, the 2 major questions. What kind of returns might we hope for? And what kind of fees are we going to pay in the meantime to try and access those returns? If this is one of your first videos you've seen of mine, I'm Brendan and I love studying this kind of thing. Sexy new investing service comes out, we pick it apart. Old legacy investing service or personal finance app has a new feature, we pick it apart. We talk about what makes it worthwhile or not. And I've been doing this kind of thing for 5 years now, but I want to continue doing it indefinitely. So think about subscribing if you like this video. Let's go. So let's start with the overall details of this innovation fund. Immediately on our website, Fundrise says that their goal is to deliver long-term growth. So that's already giving us an indication of what the point is here. This isn't about getting in and out. This is not about day trading. This is about a long-term perspective. And the way they're going to do that, how they're going to target the right companies, is they're going to try and find and invest in high-growth potential private tech businesses. Now that's of course like the standard operating procedure for VC funds. That's like the bread and butter of their business and what's made them so popular in the past. But of course, Fundrise could pick whatever kind of businesses they want. I mean, they could pick landscapers or photography businesses or whatever. They're choosing to go with private tech companies though. And then they give us a little bit of insight into exactly how they do that. They're obviously not going to get into tons of detail because maybe it's proprietary or maybe we wouldn't need to know anyway. But they're basically saying by this multi-stage approach that they're not just going to dump some money in at one stage. They might come into some businesses whenever they're very new and they've got a lot of potential and invest in them. And then as they grow, the way that they participate with the company changes over time, or it could be later stage companies that are more well established. And then they mention IPOs here. If you're not familiar, IPOs is initial public offerings. That'd be like if they invested in a company and then they went public, so you could buy their stock on the stock market then. That's a potentially very profitable situation to be in if you were already investing in the company and then they went public. So I think that's kind of the goal here. But then they tell us about the kinds of sectors that they're investing in. So they're looking into artificial intelligence companies, machine learning companies, data infrastructure, vertical and horizontal software, and then basically whatever else they can think of that has long-term growth potential. And if all that doesn't mean a whole lot to you specifically, there are 19 companies already that are going to be listed below that they've already chosen to invest in. And so I'll go over those here in just a minute. But you might have noticed these numbers down below, and at first, they don't seem very inspiring because the annualized return since inception is only 1.1%. The net asset value is only 127 million. The distribution rate's really low. Like there's nothing really that appealing about all these numbers right now, but it's also a pretty darn darn new fund. This thing has been around for 2 years. I don't know how I didn't hear about it until right now. Maybe they should have sent me this mailer a little bit earlier. But from what I understand about VC, it often takes a while for things to take off. Like a company isn't going to grow overnight. Okay, you get $1 million yesterday. Does that mean that all of a sudden you're way more profitable or bigger, that you've sold a bunch more product to your customers? No, it just means that you now have options to then build up and start doing stuff. So maybe these aren't that inspiring yet, but if they're really starting from zero, they probably shouldn't be inspiring yet. Then they give us kind of a basic breakdown of the type of industry that they've invested in and how much of each industry. Obviously, AI is like a big buzzword right now, and what that means to invest in a good company, who knows? It's a very new market, but over half the fund is in data infrastructure. Another almost quarter of it is in other, and only 20% of it is in AI and machine learning. And I'm sure those ratios are going to change a bunch over the future too. And then I'm actually thankful that they've given us something like a realistic simulated return here, because they could do something like, well, the average VC firm gets 30% return. So here's what your return could be like if you got 30% returns. They didn't do that. They just said, look, here's our actual return that we've gotten in a realistic way over the last 2 years. So if you had put in $10,000 whenever you very first started this, here's how much money you would have today. And it's a pretty darn modest situation. Like if you just put this money in an S&P 500 index fund, you would have done a lot better than this. It's barely got up in value by a little over $200. You've gotten $10 in distributions. Like it's not a huge deal right now. And then for the last 2 years, they give us this nice little chart giving us historical returns so you can see it in a very transparent way since they started this fund. And also on the website, you can find things like their prospectus documents, their holdings, reports, everything that you would want to see as an investor to try and dig deeper into this. And so the way human nature works is you probably look at this and you go, that's not a good investment because all they've done is gone up by $200 in 2 years. I'm going to go pick something else. And this is where I have to kind of step in and say, those disclosure statements that say previous performance isn't an indicator of future performance. Well, that applies to years like this too when it's not done well. Just because it's not returned a bunch of money thus far doesn't mean it's always going to return a very little amount of money. I'll bet if you could map the user base of who actually invests in this little innovation fund, it would probably show you that right now there's not a whole ton of people doing it because it doesn't seem that appealing. But if this all of a sudden shot up in value by 40% by the end of the year, I'll bet people would be clamoring to it. And that's just the crazy thing about human psychology, because by then it's probably too late. You've missed the gains. It's not like a train that's going across country that if you jump on, then you're okay, you're going to make it. No, it's already had those gains. Now, what's going to happen in the future? Who knows? But those first 19 companies they've chosen to invest in have already experienced that growth, and you've already missed out on it if you weren't invested. So if you're the kind of person that gets really turned on by VC and you're like, oh man, this would be so great, I would love to do VC stuff. Of course, I'm not a VC firm. I can't afford it, but I could throw a few $100 in here. I could put a few $1,000 in there. That seems really appealing to me. To me, this still seems like the right time to be doing it. They could be completely wrong in the companies they've chosen. I could be completely wrong in my mentality about all of that, but I just want to point out that backwards kind of human psychology that often gets us in trouble and just call that out for what it is, that this is potentially still a viable time to invest in this. But speaking of the companies they've chosen to invest in, let's go through this just really briefly right now and just name drop some people so we can just see, do you recognize anything here? How new or old are these companies? What can we find out? So they tell us the name of the company, how long it's been around, if it's an early, middle, or late stage company, and then the industry it's in. And if you wanted to, you could even click into each company and find out more information about them. I think this is really nicely put together. I think it's nice to have the resources to be able to visit their website directly, like to have all this information interconnected and available to you. If you wanted to get serious enough about doing this, then I think that's the only responsible thing that Fundrise can do, is to provide all this information. If they kept all this behind some kind of wall and said, well, our companies that we're investing in are proprietary, we're going to gatekeep this, we're not going to let you know who it is or who they are or whatever, it just starts to raise a few red flags for me. I would rather actually know the real companies that you could be investing in and make all that blatantly clear. Thus far, I've never heard of any of these companies. Anthropic, Anduril, Anyscale, DBT Labs. Hey, Canva. I use Canva almost literally every day. There's that other industry. Canva, if you're not familiar, is like Photoshop for dummies. It's an easy graphic design and kind of general design software that you can use online or in an app. Really easy to use. They've really democratized that art of designing, and so that's interesting. They invested in them. Jetty, Databricks, Inspectify, Service Titan, Immuta, Jamf, Theory Ventures, Uber. Well, they've invested in Uber. That's interesting. Match, Splunk, Elastic. It's so funny. Almost all of these tech companies have just like a one-word name. It's like, how do you have a startup? Make sure that your name is only one word. ZoomInfo, Twilio, and Vanta. 19 assets, that's all the companies that they've invested in as of today. So let's answer a couple more of those questions that I laid out in the very beginning. The first one being, how liquid is your money? So if you put $3,000 into this thing, and then 6 months from now, you're like, oh shoot, I need that money back. Can I get it back out? Well, I was looking on their website to try and find more detailed information about exactly how you get your money back out if you need it, and I just don't see anything in particular laying that out. I'm probably missing something. There's probably a general terms and service like book in terms of a PDF that's on here that I'm just not seeing. But the one hint that I got on the little postcard that they sent me, such an old man reading my mail, it says quarterly liquidity. So no penalty or costs associated with redemption. And then of course there's a little asterisk and it says subject to limitations. So if I'm reading that right, what that tells me is that every quarter you'll have the option to get in or out. And so it's obviously not as liquid as something like a bank account or like a taxable brokerage investment account for the stock market, that kind of thing. But it is more liquid than potentially a standard VC firm would be, which is like, look, the money is locked up until we have a reason to pull it out. The business needs the money. They're using it to grow their business. So we can't just take it out whenever we feel like it willy-nilly. Oh wait, scratch that. I found the document. I haven't found anything specifically about the liquidity of it, but I have found a little bit of a section about taxes, because this is a different way that we're investing, right? It's not the same kind of standard situation with stocks or with a checking account that earns you a little bit of interest or whatever. So how exactly would we get taxed if we did this? Right here on page 52 of easy reading, the selling shareholders will generally recognize capital gain or capital loss equal to the difference between their adjusted tax basis in the shares sold and the amount received. So it sounds like it's fairly similar to a stock, that you're responsible for paying taxes on your capital gain. If you buy in low and then the fund goes up in value and you sell then you've bought low and sold high and you've got that profit margin there to pay taxes on. This is a massive report, and so if you want to read this, then I can put the link in the description for you. But this is some nerdy legalese right here. Another question that we need to answer is how little of money can you actually use to invest in this? It says on my little postcard that I got in the mail, as little as $10 you can get started doing this. So that's pretty cool. The barrier to entry is super low. Then it says low fees. I don't agree with that. The little postcard says low fees, no carried interest or transaction fees. Those are some fees. Those are some of the potential ways that Fundrise could charge you money. But there are other fees that are not low. For example, this fee here, called a management fee, that's 1.85%. Oh, that is dirty. That is a really high fee. And I feel like for me, typically that's a prohibitively high fee, because I just don't see how a manager is going to overcome that initial starting point being so like in the dumps. Now, could that be different because we're talking about VC here, so the potential upside is a lot greater than normal? Maybe. Could they be terrible VC fund managers who pick awful companies who are all going to fail, and they could have seen it and they didn't, and they just messed up, and in the meantime we paid them 1.85% management fees? That's also a possibility. But at least now we've established that Fundrise is not going to lose money on this deal in terms of running this like a typical fund. And maybe they don't have a way of losing money on this anyway. Because if you think about it, if they're just taking our money and they're dumping it into these companies and they're collecting their management fee in the meantime, then the companies go out of business. Well, unless Fundrise invested their own money also in the companies, then they're not out any money. I mean, it sucks to suck. I think at that point, they wouldn't have many customers wanting to invest in the fund, because if they all went out of business and we all lost our money, then there wouldn't be people clamoring to go do this. But really the profit motive, I think, for Fundrise is to have our money, to collect this 1.85% on it. So that's one potential thing that I think would be really cool if it was different about this innovation fund. If Fundrise actually put their money where their mouth is and they said, look, we're also going to invest in this. And so that way we have our skin in the game and we have an actual motive to make sure that these companies are as profitable as humanly possible. Because right now, if they don't have their own money in there, then they don't have the same profit motive that they would otherwise. They still have some motive, because if the companies do really well, then like I assumed with the human psychology factor, there's going to be a flood of people who want to invest in this. But I think whenever you're tied up in the same deal that we all are, that just is a show of good faith. You know, it shows us that you're in the same kind of game as we are, and we have an aligned value system. So that would be cool if that was different. But as of right now, it's not. Now, personally, will I be putting my own hard-earned dollars into this fund? Probably not. I'm still scared away by the management fee. Gosh, that's a big fee. I mean, I like the idea of having things be diversified and having things that are not correlated to the stock market at all, and being able to say, okay, we've got X amount of dollars over here, let's say in a high yield savings account, then X amount of dollars invested this way, that way, those are all in the stock market. Then this whole other complete sector of our money that has nothing to do with the stock market, because just in case the stock market doesn't perform very well, then you have a way to kind of balance out that overall return. And so I get that in theory, I get that how that should help us, and doing that kind of thing is made easier by doing this. And so it all in theory is very appealing, but for me personally, I'm not going to be jumping into it. Now, if you heard about this and you think it's very appealing, or if you're already doing it. That's not me putting the kibosh on it. Like, it's your money, it's your life, you do whatever you want, and this is not me advising you to do one way or the other. I don't have the right to do that. I just wanted to share what I found, and somehow I thought this was newer than it was. I thought this was like, hey, this is breaking news. They're sending out mailers. Let's start this new fund. No, it's 2 years old. So I was wrong about that, but I was just excited to do a little research and find out, how are they doing this? How do you make VC something that's democratized for the individual? Well, that's how you start a fund. So I think it's a cool idea, and Fundrise continues to kind of pioneer new ways to do this, like they did it with real estate. You know, you can invest in different properties without having to own the whole property. I can see also on their website that they've got something they're calling private credit. So they're doing more things that I don't even know about on here. That might be a future video in a future day. So if you want to see more about Fundrise or about private credit with Fundrise, if you want to see something in particular, then leave me a comment about that. In the meantime, the secret comment word is mail, because their silly little mailer, their junk mail that I probably should have thrown away, was a thing that helped inspire this video. So one man's junk mail is another man's YouTube video. Thank you to the channel members who get to see this video a little bit early, who get some extra goodie emojis in the comments and a couple other benefits. Thank you to everyone else for watching, and I'll see you guys tomorrow. Bye.